Oil has always been priced by the fundamental forces of supply and demand. Traders traditionally focused on the output of major producers, the level of global inventories, the political stability within oil-rich nations. These factors remain crucial to understanding the market's direction. However, a new and powerful set of variables has emerged, reshaping how a barrel of oil is valued. Today, the journey of that barrel from the wellhead to the refinery is as important as its origin. The risk associated with a specific sea lane, the rising cost of insurance, the sheer length of a voyage, the accessibility of ports, these now dictate a significant portion of the final price. This is the new geography of oil pricing. The map of the world's oceans is a primary chart for energy traders. We are moving away from a world where a barrel is a simple, fungible commodity. A barrel is no longer just a barrel. Its value is increasingly defined by its location and the path it must travel. A barrel loaded in a calm, secure region with a short route is cheaper to transport. A barrel that must transit a contested choke point, take a longer voyage, and carry a hefty insurance premium is more expensive. That differential is now a central determinant of price, creating a multi-tiered market where logistical challenges translate into dollars and cents. The shift from ground to sea has real consequences. For nations, for corporations, for consumers. To understand the power of sea lanes in oil pricing, one must begin with the Strait of Hormuz. This narrow channel separating the Persian Gulf from the Gulf of Oman and the open Arabian Sea is arguably the most critical single point of passage for the global energy supply. It is a slender waterway, only about 21 nautical miles wide at its narrowest point, but through it flows a colossal volume of the world's energy. Roughly 1/5 of all globally consumed oil, amounting to approximately 21 million barrels per day, makes this transit. The sheer concentration of transit in such a confined space makes the market exceptionally vulnerable to disruption, and the strategic importance of Hormuz is not limited to crude oil. It is also a vital conduit for liquefied natural gas. Qatar ships the vast majority of its LNG through the strait. For countries in Asia and Europe that depend on these imports, safe passage through Hormuz is a matter of national economic security. It is the arterial waterway that keeps the lights on and factories running for a significant portion of the world. The geography of the strait contributes directly to its fragility. Bordered by Iran to the north and Oman to the south, at the nexus of Middle East tensions, the constant presence of military vessels, a history of confrontations, and periodic threats to close the waterway create persistent risk. Ship owners, insurers, and oil traders must account for it every single day. Even a whisper of threat can send shockwaves. Insurance premiums spike, freight rates climb, long before a barrel is delayed. Hormuz acts as a barometer for geopolitical risk. When tensions rise, moving oil costs more, and that Hormuz premium is reflected in global prices. Traders now watch rhetoric, deployments, and drone activity with the same intensity once reserved for OPEC announcements. Physical security at this choke point rivals production decisions in Riyadh or Abu Dhabi. Oil's price is geology and economics, but also geography and power. For centuries, the Red Sea and the Suez Canal have been a vital shortcut for east-west trade. For oil, this route is paramount, allowing Gulf cargoes to reach Europe and America faster and cheaper than alternatives. A typical voyage via the Suez takes around 19 days. When secure, it is a model of logistical efficiency that underpins global energy flows. Instability at the Red Sea's southern gate, Bab el-Mandeb, has altered this calculus, turning a shortcut into a high-risk gamble. When unsafe, ship owners reroute around the entire continent via the Cape of Good Hope. This adds roughly 3,500 nautical miles and 10-14 days per leg, stretching round trips from just over a month to nearly 2. Extra time isn't free. More fuel, more payroll, and the ship is unavailable for other charters, tightening fleet supply. Freight rates are the first to react. Longer voyages mean higher daily charges and transport surcharges. A localized Red Sea threat becomes a global pricing issue. Buyers pay more not for oil scarcity, but for safe delivery. The Red Sea route, once prized for speed and cost-effectiveness, now carries a significant risk premium. Conversely, the longer Cape route offers predictability and safety. The market prices cargoes by route. A barrel via the Cape can be a more reliable asset than one dashing through the Red Sea. Instability has redrawn flows, pushing the industry back toward a maritime geography that predates the Suez Canal. Costs cascade down the chain and show up at pumps and airports. Gasoline, diesel, jet fuel. Understanding this dynamic is essential for policymakers focused on energy security and for investors navigating volatility. Risks once seen as exceptional, piracy, regional conflict in narrow waterways, are becoming more frequent and priced in. The market now embeds a higher baseline of uncertainty. The journey itself is a primary driver of value. Beyond extra fuel and time lies a more complex factor: insurance. Vessels carry hull and machinery coverage and P&I liability protection. Entering high-risk regions triggers an extra charge, the war risk premium. It covers potential loss from acts of war, terrorism, piracy, and political violence. Application is swift and reactive. The Joint War Committee in London designates listed areas, like the southern Red Sea or the Strait of Hormuz. Shipowners must notify underwriters and pay added premiums for each transit. Premiums are quoted as a percent of hull value. Small percentages can mean big dollars. A single missile, a drone, or a credible threat can hike premiums overnight. For example, war risk can jump from 0.1% to 0.5%, or even 1.0% in days. On a $200 million tanker, that's $200,000 rising to over $1,000 per transit. Owners pass this through as a surcharge to charterers, becoming part of landed crude cost. Ultimately, it links geopolitical instability to prices at the pump. Analysts watch JWC pronouncements and war risk quotes as closely as OPEC figures. Changes in insurance are early indicators of rising transportation costs. The war risk clause is the price of security. When it rises, every barrel on dangerous lanes costs more. This premiumized geography now codefines global oil pricing. Freight rates, the geometry of global trade routes. These inputs quantify uncertainty, and they move markets fast. The ripple effect on European energy security. Europe's direct Gulf crude dependence has declined, with more from the Atlantic Basin, North Sea, and West Africa, yet Europe remains exposed because the oil market is interconnected. Pressure in one area displaces flows elsewhere. Red Sea and Hormuz risks send shockwaves through global prices and European energy costs. Forced longer routes tie up more ships, reduce vessel availability, and drive freight rates worldwide. European buyers charter from the US and Nigeria but face tighter, pricier freight markets. Europe imports significant diesel, often from new Middle East and Indian refineries, assuming low-cost Suez transit. If Suez is compromised, buyers pay more for rerouted cargoes or seek farther US supplies. Both raise costs. Diesel prices rise, revealing a vulnerability. Diversified crude cannot fully shield Europe from seaborne market shocks. Maritime choke point stability is central to Europe's energy security, regardless of cargo destinations. Rising insurance, freight, and longer voyages in the Red Sea and Persian Gulf feed EU energy inflation. West Africa's shifting role in Atlantic margins. Instability in Middle Eastern lanes spotlights West Africa, Nigeria, and Angola, long supplied high-quality crude. As Middle East voyages lengthen and risk up, West African barrels grow more attractive for Atlantic buyers. More West African oil stays in basin, lifting local demand, prices, and state revenues, but stressing port capacity. Congestion rises, bunkering patterns shift to West and South African ports, creating new revenue and logistical strain. Higher global freight lifts import costs for gasoline and diesel, benefiting crude exporters even as consumers face higher pump prices. Consider a VLCC carrying 2 million barrels from the Persian Gulf to northwest Europe. Standard Suez route is about 6,500 nautical miles and 19 days, with daily hire, fuel, and substantial canal tolls. Instability forces a Cape of Good Hope detour, approximately 11,000 nautical miles and 33 days. An added 14 days can exceed $2 million in extra costs, over $1,000 more in bunker fuel, plus $700,000, $1,400,000 in extra hire, dwarfing any saved Suez toll. The added cost surpasses $2 million, at least $1 per barrel. For a smaller LR2 of 700,000 barrels, fixed costs amplify. $1.5 million equals 2 $13 per barrel. Route alone now directly and measurably moves market prices. The oil market is a fluid network of specialized ships. A choke point doesn't stop flow, it reorganizes it, like traffic around a highway closure. Tankers can be reconsigned mid-voyage. Final destination confirms near a strategic decision point based on best price. When Suez is effectively closed, that flexibility disappears. Ships are forced onto longer paths. Ton-mile demand soars, even if global consumption is flat. Ships work harder and travel farther to deliver the same barrels. Effective ship supply tightens. Charter prices rise everywhere, even far from the disruption. Markets are forward-looking. Futures and forward charters price in longer voyage times the moment risks emerge. Route shocks hit refined products even harder, smaller parcel sizes and tighter regional balances. Europe is structurally short diesel. The US East Coast can be short gasoline. Products must reach thousands of terminals, with varying specs and seasonality. Substitution is limited. A delayed summer-grade gasoline or low-sulfur diesel cargo can disrupt a local market more than a generic crude delay. Longer routes, more fuel, higher insurance, fixed costs spread over smaller parcels lift per-gallon prices. Refineries relying on steady imported intermediates may cut runs if deliveries slip, tightening local supply. If ships can't call, surpluses build locally while deficits grow elsewhere, fueling volatility. To read prices, study the water, choke points, insurance, freight, and voyage times. Monitor Hormuz, Bab el-Mandeb, the Suez Canal, the Strait of Malacca, and the Turkish Straits. Any conflict, accident, or threat in these narrows is a direct signal of volatility. Watch the insurance market. JWC listings and war risk quotes are real-time gauges of perceived risk. Track tanker earnings. If unaffected routes rise too, ton-mile demand from rerouting is tightening the whole system. Follow port closures, congestion, and denied entries. When Gulf to Europe times climb from 19 toward 30 days,